Welcome back, friends. So, we saw the US market stumble on Tuesday on the back of rising Treasury bond yields. The Dow closed down more than 800 points. NASDAQ was down over 270 points at close. It had recovered smartly after an initial fall at open, and to the extent that it was up almost 95 points at one point of time. But the towards the end of the session, we saw some fresh sell-off, which caused the Dow Jones and Nasdaq both to fall and tumble quite sharply. So here we stand. The US debt and deficit situation is getting worse by the day and is facing the real prospects of getting into a rather difficult situation, triggering a high profile credit rating downgrade from Moody's and another selling stampede we saw in stocks and bonds. Whether the recoil in the financial markets continues is largely in the hands of policymakers who seem intent on adding to the US fiscal problems in the name of stimulating growth. That is something. Growth needs to be stimulated. I definitely agree with it. But the deficit problem will wake up the bond vigilantes, and it's not to be taken so lightly. Moody's didn't tell us anything that we didn't really know, but they did underscore that things aren't going in the right direction. The big beautiful bill, which causes tax cuts and also cut in spending, and nicely described as the big beautiful bill by President Donald Trump, is something which has not been accepted by the Republicans in its entirety. When it comes to debt and deficits, probably it's not going in the right direction. The result is that the United States is likely to add to its $36.2 trillion debt load, of which $28.9 trillion is directly held by the public. Tax cuts that aren't matched with less spending may also pressurize the budget deficit, which is heading towards 7% of the gross domestic product of the United States. Moody's ratings last Friday on US debt from its top rating, though it changed the outlook from negative to stable, has not told something very, very different. It is just underscored certain aspects which were really known to the public in general. The agency cited unresolved large annual fiscal deficits and growing interest costs as the reason behind the move, though it did not specifically mention the House spending bill. Add to that trade tensions the United States has initiated with Japan and China, the largest and third largest foreign holders of treasury debt, and it makes for an unholy cocktail. You put all that together, the market is increasing the risk premium for long-term bonds. There is a global repricing in a world where there is just more sovereign debt and a lot more uncertainty about whether policies are going to adjust to make that look attractive. What it's meant in market terms has been a severe leg up in treasury yields, particularly in the longer denominated debts such as the 10-year note and the 30-year bond. Investors are demanding higher yields as compensation for the risk that they are taking holding US debt. In normal times, treasuries are considered as a risk-free investments, as there is virtually zero risk that the US ever would default. However, rising worries about the fiscal situation and a resurgence in inflation from tariffs, not to mention Moody's downgrade, are forcing yields higher, with the deficit heading to 6 to 5 to 7% of GDP that is inconsistent with the debt to GDP stability over the longer run. Absent a clearer commitment towards putting deficits on a downward path, investor concerns about the US fiscal dynamics are likely to persist. How much the budget will go stretched is dependent on the final package that goes to the Congress, but markets are betting that making the 2017 tax cuts permanent as well as eliminating taxes on tips and overtime with only partial revenue offsets will aggravate the fiscal problems and the budget deficit. If the bill fails, then the financial markets won't be happy. But if it passes, well, that might just be as problematic as well. Why? Because budget deficits do matter. That's especially so when they lead to higher interest rates, higher bond yields, and potentially higher inflation. We suspect the bond vigilantes already anticipate this. We have seen a good sell-off in the US markets today. And if you were to go by what I analyze, I believe that the markets are headed towards another good fall tomorrow, which is Wednesday, May 22nd. So I believe that another sell-off is likely in the US markets tomorrow. To get to know more where the US markets are headed in the short, medium, and long term, do join our Prime Plus Telegram group, which gives you good insight into where the markets are headed, where the bonds are headed, where gold is headed, where the crypto is headed. And you can do all this by WhatsApping us on 982-086-1044. Alternatively, you can also email us at globalmoneyinnvestor@gmail.com. Happy investing. Have a great investing week ahead. Take care. Bye-bye.